The election is almost upon us, and the market's been through a lot of volatile weeks. And most of the volatility was seen with tech stocks in recent weeks, as the big tech stocks like Apple, Microsoft, Amazon, Facebook, and Google trade in the higher PE ratios, and these five companies make up over 20% of the S&P 500's basket of stocks. Back during the dot-com bubble, tech stocks made up over 18% of the S&P 500, and some analysts are saying that this is a sign that these FANG stocks are overvalued, since we have long passed the 18% mark. But we have to remember that these five companies are actually making a ton of money, unlike a lot of the tech companies in the dot-com era. And the COVID environment has benefited some or most of their businesses. But overall, the markets seem to believe that raising prices past current levels is unreasonable, at least until the next round of earnings come in. And a lot of people are concerned with the stock market's movements if Biden wins the election, primarily because of his radically different corporate tax policies compared to President Trump. Let's dive deeper into the details on the differences between Biden and Trump's policies. First, to talk about the tax policies on the individual level, Biden wants to raise taxes for high-income individuals by raising back the top tax bracket to pre-Trump levels, from 37% to 39.6%. In contrast, Trump wants to keep the current maximum tax rate at 37%, and he has also hinted at possibly lowering the tax rate for middle-income individuals. And for capital gains, Biden wants to increase the long-term capital gains rate for those making over $1 million per year. And Trump wants to do the opposite by lowering the maximum long-term capital gains rate to 15% instead of 23.8%. And I discuss more about capital gains tax and how you can minimize them in one of the videos I posted this month, so make sure to check it out. Link will be in the description. And Biden also wants to increase taxes paid by corporations from 21% to 28%, which President Trump actually dropped from as high as 35% to 21% through the Tax Cuts and Jobs Act of 2017. And Biden wants to increase the tax rate of the Global Intangible Low-Taxed Income, abbreviated as GILTI. This is essentially the taxes that US companies have to pay for intangible assets, like patents, that they are making money in other countries. And this tax rate was created in 2017 to prevent US companies from moving their operations abroad to avoid paying taxes on their intangible assets. So by almost doubling this tax rate, Biden may be trying to prevent US companies from moving their income sources abroad. Trump is also trying to bring US companies back to incentivize US companies to manufacture in the country with the Made in America tax credit, which allows for 100% expensing for certain industries that bring back manufacturing to the United States. But some analysts are expecting if Biden is elected and he carries through with his proposed tax plans that has been revealed so far, the S&P 500's earnings could fall by as much as 9.2%. And some of the hardest hit sectors would be IT, communication services, and consumer discretionary sectors. But keep in mind that Biden won't be able to enforce these new tax laws as soon as he becomes president. If he is elected, he needs to win over the Senate to cut taxes like he's proposing. But there is a sector that would benefit from Biden's policies. As most of you guys are probably aware, Biden is really big on renewable energy and the issue of global warming. He says the US will rejoin the Paris Climate Accord, and the US will target to be carbon neutral by 2050. And he plans to invest over $400 billion in 10 years in clean energy and innovation. So most renewable companies can probably expect to benefit from Biden's policies for the next 4 years if he does get elected. I might talk a little bit more in depth about the individual stocks that will benefit in a later video, so don't forget to hit that subscribe button, and I will see you guys in the next one.